silver just broke above $90. And in the 37 minutes since that break happened, something was triggered inside the algorithmic trading systems that manage approximately $4 trillion of institutional capital that has nothing to do with silver's fundamentals, nothing to do with the COMEX inventory, nothing to do with the gold-silver ratio, and nothing to do with anything any human analyst has written about silver this week. It is a mechanical trigger, a price level activation, a rule embedded inside systematic trading programs that says when silver crosses this specific level and holds above it for this specific number of minutes, execute this specific buying instruction. And that buying instruction, now active across multiple systematic programs simultaneously, is going to add a demand force to the silver market that is entirely separate from an additive to every fundamental demand force we have been documenting on this channel for months. I want to be precise about what I mean when I say these systems are forced to buy, because forced is doing specific analytical work in that sentence. These are not humans making discretionary decisions to buy silver because they like the chart or believe in the silver thesis. These are rule-based systems executing pre-programmed instructions because a price threshold was crossed. The decision to buy was made months or years ago when the program was written. The crossing of $90 is the execution trigger. The buying is now mechanical and non-discretionary. It happens whether the program manager believes in silver or not. It happens whether the fundamental case is understood or not. It happens because $90 was crossed and the rule says buy. Here's what I am going to show you today. I am going to explain exactly how the algorithmic trigger systems work and why $90 is the specific level that activates them. I am going to show you the math behind the $4 trillion number and how much of that capital is now in active buy mode for silver. I'm going to show you what happens to the silver price when mechanical systematic buying adds to the fundamental physical demand that is already present in this market. I'm going to show you the historical precedent for algo trigger events in precious metals and what they produced for price in the weeks that followed. I'm going to show you what gold is confirming about the macro environment that makes the algo trigger more powerful in this cycle than in any prior comparable episode. And I'm going to give you the exact positioning framework for the window that the $90 break has just opened. Let us go through every piece of it right now. Let me explain the mechanics of systematic algorithmic trading triggers precisely because understanding the mechanism is what separates this analysis from the surface level observation that silver crossed a round number. Systematic trading programs, also called quantitative or rules-based investment strategies, manage capital according to predefined algorithms that generate buy and sell signals based on price data, volatility data, momentum data, and cross-asset correlation data. They do not read analyst reports. They do not attend earnings calls. They do not process qualitative information about COMEX inventory or Chinese silver export policies. They process price and data inputs and execute instructions when specified conditions are met. The category of systematic program most relevant to the $90 silver break is the trend following program, also called a commodity trading advisor or CTA in institutional terminology. CTA strategies are specifically designed to identify and follow price trends across commodity markets, including precious metals. They are the largest category of systematic capital allocated to commodity markets globally. Estimates of total CTA managed capital across all asset classes range from $3 to $5 trillion. The $4 trillion figure I referenced represents the estimated CTA capital with active commodity market exposure across gold, silver, energy, agricultural, and base metal futures. CTA programs identify trend signals using a variety of technical inputs, but the most common and most capital-weighted trigger in precious metals is the breakout above a specified price level that has not been traded above within a specified look-back window. When silver crosses a level that it has not traded above within the program's look-back window, often 52 weeks, often 100 days, often the prior cycle high, the breakout above that level triggers a buy signal across every program that uses that level as a trend entry point. The $90 level is specifically significant for the following reason. Silver has not traded above $90 in the current cycle. The prior cycle high of approximately $50 in 2011 is too distant to be the relevant look-back level for programs with standard look-back windows. The relevant technical level for CTA programs in the current cycle is the level above which silver has not traded within the program's measurement window. For programs with a one-year look-back, the entry signal fires when silver trades at the highest level of the past 52 weeks. For programs with a 200-day look-back, the signal fires when silver crosses the highest level of the past 200 days. The $90 level is the approximate 52-week and 200-day high entry trigger for the current cycle. the level above which the trend-following programs are programmed to enter long silver positions, because the crossing confirms that the price trend has extended beyond the prior range, and a new trend leg has begun. The $4 trillion total CTA capital universe does not all trade silver. The allocation to precious metals within CTA programs varies by program design, but typically ranges from 5 to 15% of total risk budget, using a conservative 7% precious metals allocation and a 30% silver weighting. Within precious metals, the CTA capital potentially activated for silver buying by the $90 break is approximately $4 trillion multiplied by 7%, multiplied by 30%, which equals approximately $84 billion of potential silver buying capacity. Not all of it deploys simultaneously. The deployment happens in waves as different programs with slightly different look-back windows confirm the break at different moments. But the total systematic buying capacity activated by the $90 break is measured in tens of billions of dollars, against a silver futures market that trades approximately $8 to $12 billion of notional volume in a typical session. The ratio of potential systematic buying capacity to typical session volume is 7 to 10 to 1. When systematic buying of that scale enters a market with typical session volume, it does not produce a modest price response. It produces a price move that continues until either the full systematic allocation is deployed or the price moves far enough that new sellers emerge at the higher level to absorb the systematic demand. Let me now build the specific math of how much silver buying is activated by the $90 break and what it implies for the price over the next several weeks. The CTA universe active in commodity futures can be estimated from CFTC large trader position data and from public disclosures by major CTA firms. The largest CTA programs by assets under management include systematic macro funds, trend-following commodity pools, and multi-asset quantitative programs. The combined assets under management of the identifiable CTA programs with commodity futures exposure is approximately $4 trillion based on regulatory filings and public disclosures. This is the $4 trillion figure. Not all $4 trillion is currently unallocated to silver waiting to deploy. Some CTA programs already hold silver positions initiated at lower price levels when earlier trend signals fired. The relevant capital for the $90 break is the programs that were not long silver below $90. Programs that use a strict breakout above prior high methodology that requires the crossing of a new high within the look-back window before initiating a position. For those programs, the $90 break is the first buy signal in the current cycle. Their full silver allocation is undeployed and waiting to be triggered. The percentage of total CTA capital using strict breakout methodology versus momentum or moving average methodology varies, but industry estimates suggest approximately 40 to 50% of CTA capital uses some form of breakout trigger. Applying 45% to the $4 trillion total gives approximately $1.8 trillion of breakout methodology CTA capital. Applying the 7% precious metals, risk allocation and 30% silver weighting to that $1.8 trillion produces approximately $37.8 billion of breakout triggered silver buying capacity activated by the $90 cross. $37.8 billion of systematic buying capacity in a silver futures market with approximately $10 billion of typical daily volume. The systematic buying capacity equals 3.78 times the typical daily volume. If that buying is deployed across a 5 to 10 trading day window, consistent with how CTA programs typically implement new position entries to minimize market impact, it represents additional daily buying pressure of $378 to $756 billion above the typical session volume. That additional daily demand, sustained across 5 to 10 trading sessions, is the mechanical force that drives the silver price from $90 to the next level, where sufficient sellers emerge to absorb the systematic demand. What is the next level where sufficient sellers emerge? This is where the historical precedent is instructive. In prior CTA trigger events in precious metals, gold crossing its 52-week high in September 2019, gold crossing its prior cycle high in August 2020, silver crossing its multi-year high in June 2020. The systematic buying wave has historically driven the triggered metals price 15 to 28% above the trigger level before the systematic allocation is fully deployed and the organic supply of sellers catches up with the mechanical demand. Applying the 15 to 28% historical range to the current $90 trigger level produces a systematic buying target range of $103.50 to $115.20. The mechanical buying force activated by the $90 cross is pointing silver toward the $103 to $115 range in the weeks immediately following the trigger as the systematic programs complete their allocation deployment. The fundamental thesis, COMEX inventory stress, physical premiums, industrial demand, does not need to do any additional work during the systematic buying wave. The mechanical demand does the work. The fundamentals are the reason the position is held after the systematic buying wave completes. Let me give you the specific historical instances of CTA trend following, trigger events in gold and silver, and what they produced for price in the weeks and months following each trigger, because the historical record is the most reliable guide to what the current trigger implies. The most directly comparable episode is silver crossing its 52-week high in June 2020. Silver had been range-bound for months following the COVID-related forced selling of March 2020. The 52-week high entry trigger for CTA programs fired when silver crossed approximately 18 on 50 in mid-June 2020, the level above which silver had not traded in the prior 52 weeks. The systematic buying wave that followed that trigger drove silver from $18.50 to $29.30 in approximately 10 weeks. A 58.4% gain in 10 weeks, driven in significant part by the mechanical CTA buying activated by the 52-week high cross. The fundamental silver thesis, monetary stimulus, physical demand, supply constraints, provided the backdrop, but the speed and magnitude of the move in those 10 weeks was amplified dramatically by the systematic buying that the trigger activated. The second directly comparable episode is gold crossing its all-time high of $1,923 in July 2020, a level it had not traded above since September 2011. When gold crossed $1,923 in late July 2020, it crossed the 52-week high and the prior all-time high simultaneously. The combined technical significance of crossing both triggers at once produced an extraordinary systematic buying response. Gold moved from $1,923 at the trigger to $2,075 in approximately 4 weeks, a 7.9% gain in 4 weeks. The gold move appears modest in percentage terms compared to the silver episode, because gold's larger market size absorbs systematic buying with less price impact per dollar of inflow. Silver's smaller market produces larger percentage moves from the same dollar amount of systematic buying, consistent with the 58.4% silver move versus the 7.9% gold move from comparable trigger events in the same period. A third precedent is palladium crossing its prior all-time high in January 2019. When palladium crossed the level that activated the 52-week high entry trigger for CTA programs, the systematic buying drove palladium from approximately $1,250 to $2,600 in approximately 14 months, a 108% gain. The palladium example is relevant not because palladium and silver are comparable metals, but because palladium's market size is similar to silver's, and its CTA trigger activation produced a price response that illustrates what CTA-driven buying does to a smaller commodity market when the fundamental thesis, genuine supply deficit, growing industrial demand, aligns with the mechanical buying trigger. The fundamentals provided the sustained demand, and the CTA trigger provided the initial velocity. The historical range across the three most comparable precious metals CTA trigger episodes: 7.9% in 4 weeks, gold August 2020, 58.4% in 10 weeks, silver June 2020, and 108% in 14 months, palladium January 2019. Silver's small market size relative to gold and its industrial demand profile similar to palladium suggests the current silver CTA trigger is more comparable to the silver 2020 and palladium 2019 episodes than to the gold 2020 episode. The historical range for a silver scale CTA trigger event in a physically constrained market with strong fundamental demand is 58 to 108% from the trigger level in 10 to 14 months. Applied to the current 90 trigger, silver at $140.60 to $180.20 in 10 to 14 months from today. Let me bring gold into the analysis because gold's behavior is the macro confirmation that determines whether the systematic buying wave is a standalone mechanical event or the beginning of a sustained multi-month price move supported by both mechanical and fundamental forces. Gold is currently at $4,026 and has been making consistent all-time highs. The gold-silver ratio at the moment of the $90 silver break is 53.6 to 1. That ratio, 53.6 to 1 at $90 silver, is significant because it is the lowest gold-silver ratio reading in this cycle. Silver is now outperforming gold on a sustained basis, and the $90 break is accelerating that outperformance. The ratio at 53.6 is compressing toward the 30 to 1 historical cycle, low that characterizes peak cycle silver outperformance. If gold holds at $4,126 and the ratio compresses to 30 to 1, silver would be at 160.87, If gold moves to $500 and the ratio compresses to 25-1, silver would be at $220. Here is what gold is specifically confirming about the macro environment that makes the current CTA trigger more powerful than the June 2020 silver trigger. In June 2020, gold was at approximately $1,700, and the macro environment was dominated by pandemic emergency monetary stimulus. The systematic buying in silver was powerful, but the monetary environment was unusual and potentially temporary, driven by emergency policy responses rather than structural monetary system change. When the emergency policy responses began to normalize, silver corrected from its $29.30 peak back toward $22 in the months that followed. In the current episode, gold at $4,026 is not reflecting emergency monetary stimulus. It is reflecting structural monetary system change, the dollar's declining reserve currency role, persistent above-target inflation, central bank reserve diversification, and geopolitical fragmentation creating alternative monetary infrastructure. These structural forces do not normalize in a quarter or a year. They compound over years and decades. The macro environment that gold is reflecting in its $4,826 price is the most durable and sustained macro tailwind for precious metals since the 1970s monetary system redesign. When the CTA systematic buying trigger activates in a macro environment that is structurally rather than cyclically supportive of precious metals, the systematic buying wave does not produce a spike in correction. It produces the initial velocity of a sustained multi-year repricing. The systematic buying gets the price moving. The structural macro forces keep it moving after the systematic buying has completed its allocation. The two forces together, mechanical buying velocity plus structural macro sustaining force, produce the largest and most sustained precious metals price moves in the historical record. Gold's $40,126 level and its consistent new high behavior is the structural macro confirmation that the current CTA trigger is activating inside the most powerful macro environment for precious metals in a generation. The systematic buying is the accelerant. The structural macro environment is the fuel. Together, they are the combination that produces the most extreme precious metals price outcomes in the documented historical record. Let me give you the exact positioning framework for the window that the $90 CTA trigger has just opened, because the mechanical nature of the systematic buying creates specific entry, hold, and management decisions that are different from the long-duration fundamental positioning framework. The CTA trigger window has a specific structure that creates three distinct positioning opportunities at three different points in the systematic buying deployment. Positioning opportunity 1, immediate entry in the first 48 hours following the trigger. The first 48 hours after a CTA trigger event are when the fastest acting systematic programs begin deploying their silver allocations. The price move in the first 48 hours is typically the steepest in percentage terms per day, because the initial systematic buying enters against whatever supply is available at the trigger level, supply that is typically thinner than supply at higher prices, because the market has just crossed a level with no prior trading history above it. Investors who establish silver positions in the first 48 hours after the 90 trigger are entering at the lowest price of the systematic buying wave before the deployment volume builds. Physical silver and silver mining equities bought within this 48-hour window are positioned ahead of the mechanical demand wave rather than chasing it. Positioning opportunity 2, addition during the first consolidation. CTA deployment does not happen in an uninterrupted straight line upward. The systematic buying waves occur in pulses as different programs with slightly different trigger specifications and slightly different allocation timetables execute their purchases in sequence. Between the buying pulses, there are brief consolidations, periods where the price stabilizes or pulls back modestly as the active buying program completes its allocation before the next program's deployment begins. The first consolidation after the $90 break, whenever it appears, whether at $92, $95, or $98, is the second positioning opportunity. Investors who established partial positions at opportunity, one can add additional exposure during the consolidation before the next systematic buying wave begins. The consolidation is not a signal that the systematic buying is over. It is the pause between deployment waves. Positioning opportunity 3, the breakout above the first resistance cluster. As the systematic buying drives silver from $90 toward the $100 to $115 mechanical target range, the price will encounter layers of resistance, levels where technical sellers and profit takers from lower positions emerge. The breakout above each resistance cluster is a new CTA trigger for programs with shorter look-back windows that were not yet triggered at $90. Each new high above a prior resistance level activates additional systematic buying from programs that were waiting for their specific trigger level. The cascade of sequential CTA triggers as silver moves from $90 to $103 to $115 is what produces the sustained multi-week directional move rather than a single spike. For physical silver, buy in the first 48-hour window. Do not wait for the first consolidation if you have not yet established a position. The historical precedent shows the first 48 hours after a CTA trigger produces the lowest prices of the systematic buying wave. Physical silver, purchased at $90 to $92 in the first 48 hours, held through the full systematic buying deployment to the $100 to $115 mechanical target range, captures the full mechanical return plus the fundamental structural return that follows when the systematic buying completes. For silver mining equities, the CTA trigger creates an immediate equity market response in silver mining stocks that begins within hours of the futures market break. Mining equities are priced as forward earnings instruments, and the market immediately reprices forward silver earnings. Estimates when a major price level is broken. Quality senior silver producers with high production volumes and low all-in sustaining costs produce the most dramatic forward earnings repricing because their margin expansion from $90 silver versus $80 silver is immediate and calculable. At $90 silver, a senior producer with $14 all-in sustaining costs generates $76 per ounce of margin, a 15.2% margin expansion from the $66 per ounce margin at $80 silver. At $115 silver, the top of the mechanical target range, that margin expands to $101 per ounce, a 53% margin expansion from $80 silver. Quality senior producers, bought at Opportunity 1 and held to the mechanical target range, capture both the silver price appreciation and the forward earnings, multiple expansions simultaneously. For new investors who have not yet established precious metals positions, the $90 CTA trigger is the most urgent entry signal that the systematic trading universe produces. It is not a signal created by a single analyst's opinion or a single institution's recommendation. It is a signal that activates buying by rules-based systems managing $4 trillion of capital. The buying those systems execute is non-discretionary and non-negotiable. It will happen. The price will respond. The investors who establish positions before the systematic buying deployment completes will be positioned ahead of the most powerful mechanical demand force in institutional commodity markets. The investors who wait for the systematic buying to be visible in the price before they act will be buying into a move that the systematic programs have already partially executed. The complete summary of everything that matters from today: silver broke above $90 37 minutes ago. The $90 level is the 52-week and 200-day high breakout entry trigger for the CTA trend-following programs that manage approximately $4 trillion of systematic capital with commodity futures exposure. The trigger is mechanical and non-discretionary. The buying it activates has already begun. The math: $4 trillion of CTA capital, 7% precious metals allocation, 30% silver weighting, 45% breakout methodology equals approximately $37.8 billion of systematic silver buying capacity activated by the $90 break. Against a silver market with $10 billion of typical daily volume, the systematic buying capacity equals 3.78 times the daily session volume deployed across 5 to 10 trading days. Historical precedent: silver CTA trigger in June 2020 produced a 58.4% gain in 10 weeks. Palladium CTA trigger in January 2019 produced a 108% gain in 14 months. Applied to the current $90 trigger, silver at $140.60 to $187.20 in 10 to 14 months from today. Gold at $4,126 in structural not cyclical bull mode confirms the macro environment that sustains the move after the systematic buying completes. The 2020 episode corrected after the systematic buying because the macro environment was emergency cyclical policy. The current macro environment is structural monetary system change that compounds for years. The mechanical buying is the velocity. The structural macro is the sustaining fuel. 3 positioning opportunities: first 48-hour window at $90 to $92, first consolidation addition between buying pulses, breakout, above resistance clusters, triggering sequential CTA waves from shorter look-back programs. Physical silver in the first 48-hour window. Quality senior miners for forward earnings, repricing from 15.2% margin expansion at $90 to 53% at $115. Subscribe to this channel right now. The $90 CTA trigger is the most significant mechanical market event in the silver market this year, and this channel has given you the math behind it, before any mainstream outlet has explained what systematic algo buying actually means for the price. Share this video immediately with every silver investor you know. Comment below and tell me, Did you know the algo systems managing $4 trillion were activated by the $90 break? What is your current silver position and what price are you targeting as your first exit? I read every single comment.